Hi, this video is about two things: account classifications, and this is where you start making the lists of all your favorite assets, liabilities, owner's equity, revenue and expense accounts, and how the financial statements flow together. So let's get started. So first off, what is the accounting equation? You know it is assets equal liabilities plus, and we're going to be corporations, shareholders equity, plus revenue minus expense. And we know that's the accounting equation because it always is in balance. When we put our financial statements together, this is the order of, and you're saying to yourself, I'm never going to remember this, but you are, because it is she, BS, cash flow, OCI. So the easiest way is she BS. Those are the ones we're going to focus on the most. I know you can remember that. So always prepare the income statement first because you need that net income in order to fold it into the shareholders equity section. And you need to know what shareholders equity is at the end of the year in order to prepare a balance sheet at the end of the year. And then you do the cash flow statement from there, which is basically the reconciliation of what you did in your cash account during the year. So let's look at some other things. All right, classifications. We've talked about that there's basically two or three kinds of different assets. And there's current assets, assets that are going to be converted to cash within the next period, which is usually a year. And there's long-term assets. And those long-term assets are either property, plant, and equipment, or their investments, or their intangibles. Now, we've talked about property, plant, and equipment being buildings and land and equipment. And we also talked a little bit about depreciation. And there's an account in property, plant, and equipment called accumulated depreciation. So if you have a piece of equipment, right underneath that piece of equipment's account is accumulated depreciation on that piece of equipment. And it's just like what it says. It's the accumulation of all the depreciations you have taken to that date of the balance sheet. So if I look at equipment and it cost me $1,000 and accumulated depreciation has a balance of $200 in it, that means the book value or the net realizable value of that piece of equipment is 1,000 minus 200, or $800 of life is left in that property, plant, and equipment. So each of those accounts has a accumulated depreciation account associated with it. The only one that doesn't is land, because land is not depreciated. Land is forever. Investments. What investments are is long-term investments like in stocks, in bonds, in other kinds of real estate, things that you put your money and invested it in X because in hopes of it going up in value over a long period of time. Notice these are long-term investments. You're going to hold them for more than a year. Intangibles. Intangibles are things like copyrights, patents, franchises, goodwill. You can't touch them, but there's value in them, and that value can be enjoyed over more than a year. Liabilities. Well, there's two kinds. Current, your bills that are due this year, and long-term, the bills that are due next year and further out. Liabilities many times end in the word payable. accounts payable, rent payable, bills payable, utilities payable, mortgage payable, notes payable. You get the idea. Or they may start with the word unearned, like unearned revenue, unearned rent, those types of things. Shareholders equity. Since we're a corporation, there's two things. There's the external owners, also known as contributed capital. You know that is common stock, preferred stock, and their associated accounts paid in capital. So you might see common stock paid in capital, preferred stock paid in capital, and then the internally generated ownership, which shows up as retained earnings or retained income. That's the profits of the business you didn't pay out in dividends, but you retained in the business. You reinvested in the business. We also have revenue. Revenue is anything that has that price tag on it. It's sales, income, and you can have gains and losses as well on the sale of your investments. Expenses. We talked about there's cost of goods sold or operating expenses, which include selling, administrative, and general expenses. And you can have some other kinds of expenses as well, like interest expense. We previously computed the current ratio, which is what we call a liquidity measure, and it's current assets over current liabilities. And we've talked about that you want it to be at least 1, preferably 2, so that you have more current assets, resources to pay your current bills, your current liabilities. Oh, here's a problem. Let's see how we do. They want to know whether these things would show up on the balance sheet or the income statement. Well, let's first identify what kind of account it is. A for asset, L for liability, SHE, she, stockholders equity, R for revenue, or E for expense. Because if we know that, then we know what financial statement it's on. So equipment is an asset, and thus it belongs on the balance sheet, because balance sheet accounts include assets, liabilities, and shareholders' equity. Fees earned is a revenue account, so it shows up on the income statement. Retained earnings is a she account, so it will be on the balance sheet. Wages expense is an expense, so it's going to be on the income statement. Patent is an intangible, and it's an intangible asset, so it belongs on the balance sheet. Cost of goods sold is an expense, so it's on the income statement. Common stock is contributed capital, or it's a she account. Yeah, you're right. It goes on the balance sheet. Dividends payable is a liability. That means it's the dividends that have been declared but not yet paid. So it's a current liability, so it's on the balance sheet. Accumulated depreciation, you got it. It's property, plant, and equipment, and it shows up on the balance sheet. Prepaid expense. Now that was put there to make it crazy. Prepaid takes precedence. It means it's a current asset, so it belongs on the balance sheet. Prepaid expense is like prepaid rent, prepaid insurance. You have to pay for it before you use it. So thus it's a resource and it has future potential value, making it an asset. Gain is a revenue account, and so belongs on the income statement. So there you sold some short-term investments and you sold them at a profit, so that's a revenue. Rent revenue is a revenue, so it's on the income statement. Supplies inventory is an asset account, and so yeah, you got it, it's a balance sheet. Accounts receivable is an asset, and it belongs on the balance sheet. Land is an asset and it belongs on the balance sheet. Insurance expense is, I changed the color, is an expense, so it's on the income statement. Interest payable is a liability, so it's on the balance sheet. And deferred revenue is also known as unearned revenue. I have a lot of this right now, and I have a lot of them right now because there were a lot of plane tickets that I was unable to use, and because I was unable to use them, I have a lot of plane credits. And so the Delta has my money, which means for Delta it's deferred revenue because they can't recognize it as revenue until I take the plane ride. So they got my money, they got my cash, and so on their books, that is a liability account because they're responsible to give me plane rides. So it's a balance sheet account. So sorry for the rant, but yeah, I have thousands of dollars in there. All right, here's another one. They want not only what kind of account it is, but what category. So dividends payable is a current liability because you need to pay those dividends with pretty quick. Usually once dividends are declared, they need to be paid within 30 days. Payment received in advance is another way to say deferred revenue or unearned revenue. Remember those Delta plane tickets? Delta has my cash, but they need to promise me a plane ride. So it's a current liability. Allowance for uncollectible accounts. You don't know what this is. But because we have accounts receivable, so let's find accounts receivable. It's not on here, but right here. Accounts receivable is a current asset. And what accounts receivable is where I have sold something to a customer on credit, meaning, I say, I'll sell it to you now, I'll send you a bill and you can pay me later. That is an account receivable. But because we're extending credit to these customers, I know some of them are not going to pay me. So I have to estimate how many are not going to pay me. And don't worry, we'll spend at least an hour on this. So it also is a current asset. So allowance for uncollectible accounts, allowance for bad debt, allowance for doubtful accounts are all contra current assets or current assets. Inventories, that's stuff that you buy, you slap a higher price tag on and say, come in people, buy from me. So inventories is what the products you sell. And that's a current asset because hopefully you're going to sell it and collect that cash pretty quick. Capital stock is contributed capital. It's a nice umbrella account for common stock, preferred stock. You can just call it capital stock. But because it's contributed capital, it's that evidence of external owners in your business. Accumulated depreciation building. Building is property, plant, and equipment. So its associated depreciation account is also property, plant, and equipment. Bonds payable is a long-term liability. And the reason is usually when you float a bond, it's out there for years and years and years. It's a 5-year bond, a 10-year bond. It's very unusual to have a bond that has a life of less than a year. So that's long-term liability. Machinery and equipment is property, plant, and equipment. Short-term investment. Short-term means it's a current asset, meaning we're going to get rid of those investments, probably stocks that I've invested in because I had some extra cash around. So it's a current asset because it'll go back to cash within the period. Building, property, plant, and equipment. Oh my, that's a thick thing. PP&E. Patents are intangibles. Property is PP&E. Investment fund. This is kind of like a savings account because you're saving up to expand your plant. It's an investment account because you're saving, and you're saving for more than a year. Wages payable. Employees don't wait long. That's a current liability. Cash, the most liquid of all assets, is a current asset. Accumulated depreciation equipment. Property, plant, and equipment. I changed the color. Prepaid rent is prepaids. That's where you paid your rent before it was due, so it's a current asset. Trademarks is another intangible. Land held for investment. Investment here says I'm not holding this land because it's productive. I'm holding because I think it's going to go up in value. So it's an investment account, long-term asset. Current portion due on long-term debt. That's a current liability. That's the amount that it's due this year on that long-term liability, mortgage, or note payable. Accounts payable is like bills payable, or credit cards payable. It's a current liability because you need to pay those accounts this period. And short-term notes payable is a big tip-off that it is a current liability. So all of these are balance sheet accounts. It's just what kind are they? So that's the classification. All right. We said it's is, she, BS is how we do our financials. So the first one we would do would be the income statement. The second one we're going to do is the statement of shareholders' equity, or the statement of retained earnings, if we're just doing that piece. And the third one we're going to do is the balance sheet, is she BS. We'll talk about the cash flow in a later series. So what we basically have is we have the beginning of the year and we have the end of the year balance sheets. Remember, they're snapshots at a moment in time. And the big question is, what happened this year? And what happened this year shows up in these other statements because these other statements covered the period of time between the beginning and the ending balance sheet. So let's try one and see how we do. Okay, we said we do the income statement first. So the income statement for the period, we had revenues of $4,200. We had expenses of $4,050. So that means we resulted in a net income, or revenue minus expense, of $150. Sorry, that's not very pretty, is it? Let's see if I can make it prettier. Now, the net income then flows into the statement of retained earnings because at the beginning of the year, this company was in existence, as you can tell from this beginning balance sheet. And notice that the retained earnings at the beginning of the year agrees with the beginning retained earnings. We have computed that net income for the year was $150, so retained earnings is going to increase by $150. We paid out of that $150, $70 in dividends, so the ending balance in retained earnings, if I do my math right, is $580. And the ending retained earnings then shows up in the ending balance sheet of $580. So that's why you have to do the income statement first, the statement of retained earnings second. Now, since we're here and we're looking at that ending balance sheet, we can see that the contributed capital, or CC, is $1,200. And guess what? If I did a statement of contributed capital, 1,000 beginning contributed capital, right here, plus any stock that was issued that year of 200, gives us the ending contributed capital. So notice how this all kind of flows and ties. Isn't that wonderful? So from this, I'm looking at my balance sheet going, I don't know what my cash is, I don't know what my total assets are, but I can compute my total liabilities plus shareholders' equity. And that comes to $39.75. And if liabilities and shareholders' equity is $39.75, so is total assets. And because of that, then I can back into my cash, which is $825. Now, that $825 ending cash also is the ending cash on the cash flow statement, $825. Well, you'll learn how to do this, but the cash from operating, investing, and financing sources nets to $405. And, oh, here's my cash at the beginning of the year, $420. And 405 plus 420 is 825. So that's how the statements flow together. There are relationships, and those relationships stay true. All right, what else do we have? This is a really long one. I'm just going to do 1 year, and I'm going to leave it to you to do the rest of them. And if you want to check your answers, we can talk about it in class. How's that? All right, so I've got these assets, and I've got liabilities. So I'm going to make a little space here and call this total assets. Now, in the first year, all the numbers are there for all my assets, my cash, my accounts receivable, my inventory, my land, and my property, plant, and equipment. So it comes to $1,800, which means my liabilities plus shareholders' equity also has to come to $1,800. Well, if that's the case, I can back into my contributed capital, which has to be $700, because 200 plus 500 plus 700 plus 400 equals $1,800. So I know I did that backwards, but I started at the top and I didn't do the is first. So the income statement, sales minus expenses. My net income for the year, and I'm going to put the expenses in brackets so you remember to subtract, is $600. Oops. All right, now I need to figure out what dividends are, and I know that this is a brand new company, so my beginning retained earnings this year were 0, and I can see from above that my ending retained earnings are 400. Brand new company, had income of 600, but ending retained earnings is only 400. So I must have paid dividends out of $200. Make sense? Now, the ending retained earnings for this year becomes the beginning retained earnings for next year. So moving along, you can see that I can solve for this. I'm going to have to then back in, and if, well, I'm going to leave it up to you to see if you can figure it out. I bet you can find out those expenses. Look at that. If sales is $1,100 and net income is $400, the difference is probably, don't you think, going to be net income. So our net income is, so the difference is my expenses. So so it's like this figures out that number. You have fun. And if you can get that, then you're practicing with the flow of is she BS. Oh, here's a different one. So in this one, there's some information is given to you. This is one of my favorite equals favorite exam type, just so you know. So I'm given a bunch of accounts. I need to understand what financial statement they would show up in, meaning I have to know what account classification is, and then I have to solve for the unknowns. So lots of steps, lots of moving parts, thus making it one of my favorite exam types. So I would suggest we start with assets equal liabilities plus shareholders' equity plus revenue minus expense. And between these two, I'm going to throw a little box for retained earnings. So let's just go through and see if we can identify these. Sales expense is an expense. Accounts payable is a liability. Dividends shows up in retained earnings, and retained earnings, just so you know, starts with beginning plus net income minus dividends gives us the ending retained earnings. So if dividends are 6,000, I'm going to put them in brackets because we subtract them out. I've taken care of the dividends. Accounts receivable is an asset of 8,000. Commissions earned is revenue of 20,000. And you're saying to yourself, how is she remembering all this? There's not that many account titles in the world, and after you get used to it, it goes pretty quick as to being able to identify it. So utilities expense is an expense. Inventories is a current asset, 22,000. Salaries payable is a liability. Notice how those liabilities end in payable. Retained earnings, this is in January, so that's the beginning of the year, is 25,000. And common stock is $1,000. So we know that shareholders' equity is made up of the common stock and the retained earnings. So common stock, $1,000. All right, I've gotten rid of all my numbers. The things I'm missing, cash is an asset, so I'm going to make a box for cash. Net income is the difference between revenue and expense, so I'm going to make a box for net income. Total assets is the sum of all the assets. Other things, retained earnings at the end of the year, so we need a box here. So I think that has laid out or formatted the problem to the best of our ability. And what do we do first? You're right, income statement. Is she BS? So expenses come to 6,000. Revenue is 20,000. So the difference is net income, or 14,000. Once I know what net income is, I know that that is enfolded at the end of the year into the retained earnings computation. And if beginning retained earnings is 25 plus net income of 14, that comes to what, 39? And 39,000 minus 6,000 in dividends means we have ending retained earnings of 33,000. So retained earnings at the end of the year is 33,000. So total shareholders' equity is going to be 34,000. Liabilities are 8,000. For some reason it doesn't want to let me write. And that means that liabilities plus shareholders' equity, 8,000 plus 34,000 equals 42,000. Well, if liabilities and shareholders' equity is 42,000, then total assets have to be 42,000. Well, 8,000 plus 22 is only 30,000. So the cash must be 12,000. So to recap, cash 12,000, net income 14,000, total assets 42,000, and ending retained earnings 33,000. So wasn't that fun? I like these problems. Well, here's another problem. It's from your textbook, and it's the preparation of financial statements where they're giving you a whole bunch of different accounts, and you have to sort and put them in the right order. So I thought, instead of us doing that together, I would let you play the Jeopardy approach and look at the solution and track it back to the answer. Enjoy that. So what did we do today? We looked at account classifications, and we looked at the is-she-be-s order of preparation of financial statements. We're now getting down and dirty into accounting. And so other things that we've learned for sure is we've learned revenue accounts, expense accounts. There's 4 categories of asset accounts: current assets, property, plant, and equipment, investments, and intangibles. 2 types of liabilities: current liabilities and long-term liabilities. 2 types of stockholders or shareholders' equity accounts: contributed capital, which is the common stock, the preferred stock, or the capital stock, and the internal ownership, which is retained earnings. We've proved that the accounting equation does balance, that assets equal liabilities plus shareholders' equity, or we've expanded it to say assets equal liabilities plus shareholders' equity plus revenue minus expense. We've looked at 3 different types of ratios: the current ratio, the debt-to-equity ratio, and the profit margin ratio. And yes, I do expect you to know how to compute those, because those are things that people do all the time. So the current ratio is current assets over current liabilities. You want it to be more than 1. Debt to equity is total liabilities over total shareholders' equity. If it's above 1, the creditors control the company. If it's below 1, the stockholders control the company. Profit margin is net income divided by total assets, or total revenue or net revenue, depending on how the company runs. And the profit margin gives you the percentage of sales that flow to the bottom line. In other words, net income. If you got questions, please ask. But now is the time for you to take that first self-quiz and see how you do. Until next time, think accounting.